Welcome to the deep dive.
Our mission, well, it's always the same. We take these really complex, dense source materials today. It's a huge market intelligence report covering the chaos of October 10th, 2025.
A pretty wild day.
Exactly. And we pull out the key insights, the things you actually need to know. We're not about reciting data points here. We want to give you the context, the why, to help you navigate what's ahead.
And this day, October 10th, it really was a shock to the system. The market had been cruising along for months, feeling pretty good, driven by some clear trends. Complacency had definitely set in.
Yeah.
That calm just shattered on the 10th. It wasn't just a down day. It was a fundamental shift, a sudden pivot from, chasing growth and momentum to scrambling for safety. Understanding why that happened, why the reaction was so strong, is crucial for figuring out this next critical week. Right. So the core story we're pulling from these sources is pretty clear. A long, powerful rally got stopped dead in its tracks. And the trigger: geopolitical tensions rearing their head again, sending investors running from growth stocks to safer havens.
Okay, let's set the scene a bit more. Before October 10th, the market felt, well, almost too comfortable, didn't it? Maybe living on borrowed time. The sources call it these powerful twin tailwinds.
That's a good way to put it.
Yeah.
You had, first, this massive wave of excitement around artificial intelligence, just transformative stuff driving huge growth in certain sectors, almost disconnected from the wider economy.
The AI boom.
And second, you had the Fed. The market was fully expecting continued easing, more rate cuts on the horizon, lower interest rates basically fueling the fire.
So AI potential plus easy money. That's a potent mix for bulls.
Oh, absolutely. It's the dream scenario, really.
Yeah.
And it worked. Those two things had pushed the S&P 500 and the NASDAQ to brand new record highs just days before the shock.
There's this feeling of stability, maybe even invincibility, like the AI story could power through anything. Exactly. But underneath, valuations were getting really stretched, historically high, in fact. And that meant the market was incredibly sensitive, maybe fragile, to anything that threatened either that growth story or the Fed's plan. That tranquility was really just masking fragility.
And then, bam, the catalyst hits. Not bad earnings, not a jobs miss, just words. Political noise. President Trump threatening a massive increase of tariffs on Chinese goods.
That was it. That single comment just shattered the calm, exposed that fragility you mentioned.
And the timing, you said, was key. It didn't start badly.
No, actually, the day started slightly up. Investors seemed ready to just shrug off minor worries and keep the rally going. But then, mid-morning, that headline about tariffs hits the wire.
And that's when it turned.
Instantly, a sharp, sustained sell-off kicked in, wiped out the early gains and just kept going. The mood shift was absolute.
The selling was fierce. Though the indices did claw back a bit late in the day, didn't they? But the closing numbers still told a story.
They definitely did. The S&P 500 ended up with its biggest single-day loss since August. Snapped that multi-day win streak, that period of calm, definitively.
Let's look at the numbers. Dow Jones.
The Dow, which is usually more sensitive to global trade stuff, fell 243 points. That's about 0.5%. 0.52%, closing at 46,358.42.
And the S&P.
S&P 500 down 18.61 points, so 0.28%.
But the NASDAQ,
yeah,
that was interesting. It barely budged, relatively speaking. Down just 18.75 points, or 0.08%. Why was it so resilient compared to the Dow?
that tells you something important. Two things, really. One, the fear was real and broad, no question. But two, the belief in that AI theme, it's just so incredibly strong that it acted like a floor under tech stocks.
So investors sold off the global industrial exposure to the Dow, but they couldn't quite bring themselves to dump the AI leaders in the NASDAQ.
Pretty much. It suggests they see the AI revolution as this long-term transformation, something almost separate from, or at least less vulnerable to, short-term trade spats. That resilience is telling.
Okay, that makes sense. But still, why such a panic over just a threat of tariffs? We've heard this rhetoric before. What made October 10th different?
Right, it's about context and investor psychology. When valuations are sky high, like they were, investors have priced in perfection. Perfect growth, smooth global trade, no inflation.
An impossible scenario, really?
Exactly. So any threat, even just a threat, forces a violent rethink. This tariff talk immediately brought back all those fears about supply chains getting messed up, input costs rising for companies.
And a global growth slowdown.
Precisely, which directly hits expectations for future corporate earnings. When you throw that kind of uncertainty onto already massive valuations, especially for tech and consumer companies tied to China, you get an immediate, painful repricing. The market basically screamed, "We can't handle this risk at these prices."
A stark reminder that even powerful trends like AI aren't immune to old-fashioned trade war fears. And that fear wasn't just theoretical. It showed up clearly in where the money went. A classic defensive rotation, right? Capital fleeing risk. The report says 3 out of 4 stocks in the S&P fell.
Yeah, a very broad retreat. And you can see the path that money took by looking at sector performance. No surprises, really. The sectors most tied to economic growth and trade got hit hardest. Industrials down 1.45%, materials down 1.37%.
The companies that make stuff and ship stuff.
Exactly. They're on the front lines when tariff threats emerge. It's like an instant tax on their costs and a threat to their sales.
And the sources highlighted a specific example, J.P. Morgan downgrading FedEx, FDX. Not just general concern, but citing weak less than truckload shipping data.
Yeah, that LTL segment, it's a surprisingly good gauge of B2B activity. It's about smaller shipments, essential for manufacturing, distribution. If that's softening, it suggests businesses are pulling back, maybe slowing down orders, cutting investment.
So that downgrade really crystallized the fear that tariffs would hit business spending immediately.
It did. And on the flip side, where did the money go? Into defensive plays. Consumer staples companies selling essentials like food, household goods. Their ETF, XLP, was actually up for 0.31%. Utilities gained too.
A clear signal. Preserve capital, avoid volatility. Forget growth for now.
And this wasn't just happening in the stock market. The shockwaves went through everything. Cross-asset signals painted a really clear picture of fear. Let's start with gold. That was historic.
Gold futures jumped almost 1.4%, breaking through $4,000 an ounce for the first time ever. Wow. Why is $4,000 such a big deal?
Well, it's partly psychological, big round number. But fundamentally, hitting $4,000 suggests it's not just retail investors chasing momentum anymore. This signals serious institutional buying. Think pension funds, sovereign wealth funds, maybe even central banks.
Seeing gold as a hedge against
Sure.
what? Systemic risk? Geopolitics?
Both. The fact it jumped right when the tariff news hit confirms it's seen as the ultimate safe haven against trade wars, political instability, maybe even doubts about sovereign debt. It's beyond just inflation fears now.
And bonds. Same story. Rush to safety.
Yep. Strong demand for U.S. Treasuries pushed the 10-year yield down sharply, settled around 4.09%. That's a 5 basis point drop from 4.14%.
So money definitely flowed into government debt, the perceived lowest risk asset.
Absolutely. Although you could argue a 5 basis point drop isn't exactly panic stations. If investors truly feared a deep global recession from a trade war, maybe we'd have seen yields drop 10, 15 basis points.
Interesting nuance. So the bond market is worried, seeking safety, but maybe not pricing in total disaster, perhaps because the Fed's easing is still expected.
That seems plausible. It's signaling risk management, maybe not full-blown crisis mode.
Yeah.
And the VIX, the fear gauge.
It popped nearly 1% to 16.59. Definitely shows anxiety spiked.
It does. But again, 16.59, while up, isn't anywhere near the levels you see in major crises. So again, more like a psychological shock, a sudden wake-up call, rather than a systemic breakdown.
Okay, but here's where it gets really messy, right? The signal from oil prices. WTI crude fell sharply, like 3.6% at one point, down near $59 a barrel. That seems to contradict the risk-off move.
This is the big tension point, the crux of the matter, really. That drop in oil had nothing to do with the tariff fears. It was driven by completely separate news, a ceasefire apparently taking effect between Israel and Hamas in Gaza.
Oh, okay. So that eased fears of a wider Middle East conflict disrupting oil supplies.
Precisely, which is fundamentally positive news, reducing a major risk factor that had been keeping oil prices elevated.
So you got these two huge opposing forces hitting the market at the same time. Trade tensions ramp up risk tariff fears, recession worries. But lower oil prices actually reduce risk, specifically inflation risk, which could encourage the Fed to keep easing.
It's an incredibly tricky mix. Which matters more? The fear of trade disruptions slowing growth, or the relief from lower energy costs potentially boosting the economy and helping the Fed? The market went from having clear direction to facing this really complex internal conflict. Uncertainty just shot way up.
And layered on top of all that global drama, we've got problems right here at home. The U.S. government shutdown is still going on, creating this data vacuum just when we need clarity.
Yeah, the lack of official economic data is a real issue for investors trying to gauge what's happening. But it's getting tangible now, too. Friday was the first day federal workers missed paychecks.
Ouch. That's got to hurt consumer spending eventually, right? Especially heading into the holidays.
You'd have to think so. The consumer is the engine of the U.S. economy. If a chunk of workers aren't getting paid, that's a drag, a significant headwind.
And consumer confidence was already looking shaky even before the missed paychecks. The University of Michigan sentiment reading for October came in weak.
Yeah, a 5-month low. Fell to 55.0, below what analysts expected. The report links it to nagging inflation still eating away at budgets and also signs of weakening job prospects, people feeling less secure.
So you've got this disconnect. Consumer sentiment is falling, but so far, actual spending has held up okay. That feels like a vulnerability.
It really does. That gap between feelings and actions can't last forever, especially if the shutdown continues.
But, okay, amidst all this gloom and macro uncertainty, some individual stocks just completely did their own thing. It shows company-specific stories can still dominate. Let's look at Protagonist Therapeutics, BTGX. What a day for them.
Unbelievable performance, really. Just completely defied the market meltdown. The stock surged, wait for it, 30.28%, closed at $87.38.
30%. On a day the S&P is getting hammered? What drove that?
M&A buzz. A report surfaced that pharma giant Johnson & Johnson, J&J, is in talks to buy them out. That's all it took. The prospect of a takeover by a major player sent the stock soaring to an all-time high.
Was there underlying strength already?
Oh, yeah. PTGX wasn't just some random pop. The stock was already up almost 100% over the past year. They've had really positive clinical trial results for some promising drugs in their pipeline, rusfertide and icotrokinra, targeting big markets.
So the market sees real, non-cyclical value in that biotech pipeline. The J&J news just put a takeover premium on top.
Exactly. It instantly repriced the stock from being a promising but still somewhat speculative biotech to being a strategic asset that a giant wants. Proof that M&A can totally override macro fears.
Okay, now let's flip to the other extreme. Venture Global, the LNG exporter, ticker VG. Total disaster.
Yeah, a brutal day for them. Shares just collapsed, down 24.29% to a record low of $9.54. A complete wipeout.
And this was purely company-specific too, a legal issue.
A huge legal defeat. They revealed late Thursday that the International Chamber of Commerce ruled against them in a big arbitration case with BP. The ruling said Venture Global breached a long-term contract, basically didn't deliver LNG cargoes they were supposed to from their Kaukazoo Pass facility.
Why didn't they deliver?
Well, the allegation from analysts and customers like BP is that Venture Global was holding back those contract cargoes because they could sell them for much higher prices on the spot market given the global energy crunch. Opportunism, basically.
And this ruling was a surprise.
Huge surprise. Because just 8 weeks earlier, Venture Global had actually won a similar case against Shell. That win gave investors confidence these contract disputes would go away. This BP ruling completely shattered that. Now BP wants over $1 billion in damages.
And it opens the door for others.
That's the killer. It emboldens all the other customers with similar claims. Edison, Galp, potentially others. Analysts are now talking about total potential liabilities exceeding $5 billion. That fundamentally changes the company's entire financial picture, its risk profile. The market just repriced that massive new liability overnight.
Wow. Shows how devastating legal risk can be.
Okay.
Any other interesting stock moves that day?
A few worth noting. NVIDIA, actually held up pretty well despite the tech softness. News came out that the U.S. government approved billions in advanced chip exports for AI projects in the UAE.
So confirmation that the big AI infrastructure spending is still happening globally.
Seems like it. And then you had PepsiCo and Delta Airlines. Both rallied over 4% after reporting good earnings and giving upbeat guidance.
That's a direct counterpoint to the weak consumer sentiment data, isn't it? People are still buying snacks and flying.
Especially premium consumers, perhaps, in Delta's case. And essentials like PepsiCo's products. It's valuable real-time data suggesting spending hasn't fallen off a cliff, despite the survey pessimism.
But the market wasn't forgiving everywhere. High valuations got punished. Levi Strauss, LS, dropped over 12%, even though they beat profit estimates.
Yeah, that stock had run up like 42% year-to-date. It was priced for perfection, basically. Anything less than a flawless report, and boom. Vulnerable.
And Oracle, ORCL, fell too. Something about AI profit margins.
Down 2.5%. A report suggested that some of their key AI-related cloud business lines have pretty thin profit margins. And that might be the most important underlying theme of the day. Investors are starting to look beyond just the AI hype.
They want to see profits now, not just growth.
Exactly. The era of just rewarding revenue growth in AI without seeing clear profitability might be ending. Scrutiny is increasing.
Okay, so October 10th leaves us with this messy picture. New tariff threats, a government shutdown, gold soaring, oil falling, diverging stock stories. The market basically hit a wall.
Right.
So what now? This coming week, October 13th to 17th, feels absolutely critical. packed with data and the start of earnings season.
It really is pivotal. The market's at a crossroads. It has to digest this new geopolitical reality alongside a flood of economic news and company results. First up, the big one, inflation and the Fed. You have to remember, the market's still betting heavily on at least one more rate cut this year, after the first one last month.
Right, so these inflation reports are make or break for that expectation.
Totally. Wednesday morning, 8:530 Eastern, we get the Consumer Price Index, CPI. That's the main event. Everyone will be watching that. And the key number within CPI.
Core CPI, right. Stripping out food and energy.
Exactly. That shows the underlying stickiness in things like services and housing costs. That's what the Fed really watches. If core CPI stays stubbornly high, it makes it really hard for the Fed to keep cutting rates. They might have to pause, or worse, that would hammer growth stocks.
Then more inflation data on Thursday.
Yep, Producer Price Index, PPI. That measures wholesale prices, so it's kind of a leading indicator for consumer prices down the road. If PPI cools off, especially with oil prices having dropped, that'd be a good sign.
And also Thursday morning, retail sales. Huge indicator for consumer health. How much are people actually spending versus just saying they're worried?
Crucial piece of the puzzle. We need to see if spending holds up despite the weak sentiment and the shutdown hitting paychecks. This gives us a real-time read on the main engine of the economy.
And just a scheduling note. Monday the 13th is Columbus Day. Stock market's open, but the bond market is closed. So maybe lighter trading to start the week.
Could be. Lower volume, maybe less liquidity before all the big data hits midweek.
Okay, so that's the macro. Then there's the micro. Q3 earnings season kicks off. And this time, it feels even more important because of the shutdown delaying government data.
You're right. Corporate earnings calls become maybe the best real-time source of information on what's actually happening on the ground. How are companies seeing demand? Are they able to pass on costs? What's their outlook?
And the overall forecast is still pretty good. Analysts expecting 10% year-over-year earnings growth for the S&P 500.
That's the consensus. If it holds, that would be the fourth straight quarter of double-digit growth. That's a strong, fundamental underpinning for the market, a potential buffer against the macro fears. The big question is whether companies maintain that optimism in their guidance for Q4.
And first out of the gate, as always, are the big banks. They give us that first real look under the hood of the economy.
Absolutely critical. Their results tell us about consumer health through loan performance, credit growth, borrowing demand, and what's happening in capital markets now that volatility is back. They're the canary in the coal mine.
Tuesday looks massive for banks.
Yeah.
JP Morgan, Goldman Sachs, Citi, Wells Fargo, all reporting. What are we looking for there?
Key things are net interest income, the spread they make on lending. Okay. Also, credit loss provisions. Are they setting aside more money for potential bad loans? And what's the outlook for deal-making, investment banking in this uncertain environment?
And Wednesday brings Bank of America and Morgan Stanley. More insights there, maybe on wealth management, higher-end consumer spending.
Yeah, exactly. Plus, other key reports next week include J&J relevant after that PTGX news. Taiwan Semiconductor, TSM huge for global chip demand and AI orders, and American Express, AXP, another lens on premium consumer spending. It's going to be a data-packed week. #outro.
Okay, let's try to pull this all together. We've covered a lot. What does this mean for you trying to make sense of a market that just got a major jolt? It feels like we're caught between two really strong opposing forces now.
That's the perfect way to describe it. You have the bull case, which is still there, right? It's supported by that powerful long-term AI growth story, the fact the Fed has started easing rates, and underlying corporate profits look decent, assuming that 10% growth comes through. That engine hasn't completely stalled.
The bear case just got a massive shot of adrenaline on October 10th. The tariff shock, hitting already stretched valuations, plus the shutdown mess here at home, plus weakening consumer sentiment, the market's vulnerability was suddenly very clear.
Absolutely. So the key takeaway, I think, is that we've shifted. We're moving away from a period where the path seemed pretty clear, those twin tailwinds were pushing everything up, into a much more complex, volatile phase where the risks feel very balanced, maybe even tilted negative short term.
Complacency is definitely out the window.
Gone. The inflation data this week, starting with CPI, and then the guidance we hear from the banks and other early reporters, those are the immediate tests. They will really gauge the market's conviction and likely set the direction for the next phase. You have to pay close attention now.
That rapid switch from calm to fear really underscores how sensitive things were, how dependent the market was on that growth narrative holding perfectly.
It does. And that brings us to a final thought, something for you to chew on as we head into this critical week. Think about this. We saw gold spike to $4,000, right? A clear signal of deep institutional fear wanting a safe haven from systemic risk.
Yeah.
But at the exact same time, crude oil prices plunged. That suggests a major inflationary pressure might actually be easing significantly, and lower inflation is ultimately good for the economy, good for stocks, and gives the Fed room to cut rates.
So which force wins out?
That's the question. Is it the paralyzing fear of a trade war potentially causing a recession? Or is it the fundamental relief from lower energy costs, potentially boosting growth and supporting the Fed's easing path? Which narrative proves more powerful in shaping decisions both for investors and for the Fed itself? That's the core tension to watch as earnings season gets underway.